So continuing with the income statement, we have here gross profit. What is gross profit? Basically, as you know, I'm sure, we're looking at how much we're making after the cost of goods sold, sales less cost of goods sold, and think about it this way: how much are you making per a line of clothes when you sell it per shirt? How much did it cost to basically make that shirt versus how much you're making on that shirt? So essentially, this includes the labor, manufacturing type of costs associated with that specific product. It may not include marketing, the administrative, like they may not include rent on the building, but this is basically gross profit is just how much is it selling as opposed to how much did it cost to make it. And of course, if you look at it on a detail level, what does this really mean is how much did it cost to make that product, and really shows the effectiveness of the profitability of the company. We're just in my other class talking about how Nike, for example, can command higher prices so they have a higher gross profit, or they're reducing their costs because they're using less labor, more sort of 3D printing for the shoes, and that's costing less, so that's a higher gross profit. So things like that in terms of overall business situation. In terms of the expense side of the income statement, what are we really looking at? We have basically matching principle that we're looking at, and basically we want to match the revenues and expenses in the same period that they are earned and incurred. And then we have periodic expenses like salaries or something like that that have to be booked in the period that they were essentially incurred. And then there's costs regarding assets like depreciation that get allocated. So the main principle is matching. We really want to make sure that whatever has been used up in terms of resources is booked in the right period of time, and measurement, the number has to be accurate. So the right depreciation table, the right depreciation method, in terms of salaries, what period, say they got bonuses, but it was for last year's work and now we just made it to next year. So where do we book that? Into last year, because that's when the work was done. So basically it's matching and making sure that it's inclusive of everything as well for completeness. Operating expenses are reported in the following classification on the income statement. So we have selling expenses, general and administrative expenses, research and development expenses. So these are different expenses that are there, and we bucket various expenses into these three categories. Notice some of the big companies out there, you see that they have very concise income statements because there's a lot of this bucketing going on. And here we look sales, cost of goods sold, so we look at gross profit, and then we're looking at selling, like something like marketing and all that. General administrative could be like your accounting and rent and stuff like that. And then depreciation on assets, showing you, hey, this is the product itself. This is the basically operating expenses for the business, marketing, accounting and rent and depreciation. And then we see income from operations. After income from operations, we also want to basically back out the or include interest income, gains on sales of assets. These are basically non-operating income, and other expenses and losses. So we have interest expense, loss on sale of investments, then basically income before tax, and then we look at income tax expense and net income. And that's basically the main breakout that we want to notice is like income before taxes, and notice we're breaking out gross profit, income from operations, and then we break out we're breaking out gain on sale of planned assets. We're basically breaking out other revenues and gains and other expenses and losses. So it's basically showing you the core income of the business, and then it's showing you the non-core income and losses of the business, and then tax as well is separate because why is this really broken out this way is because a lot of times businesses are really looking to see, or analysts are looking to see, if you're looking at a big company, they are looking to see what is your growth going to be, because your growth really, as we discussed, indicates the future valuation, everything for investment. So the growth of the business will come primarily here and here in the gross profit and in the income from operations. If you're going to become more efficient, you're going to see evidence here. If you're going to have more sales, you're going to see that here. So growth, increasing market share, reducing costs. If you're reducing costs, likely you're reducing costs here, or you're reducing costs somewhere over here in the manufacturing process. And you could basically then estimate your future growth. It's not going to come from paying less interest or selling other assets or tax. Not from your core business. It's not going to be like something you improved your manufacturing. It's not going to affect all these things, and that's why they break it out, and that's an important thing for analysts to see when they look at something like this. Another item that we want to be aware of is the earnings per share piece, and understand that basically what is going on with shares. And the main thing that we do with shares outstanding is we simply look at how many shares that have been outstanding, and if it changes, what we do is we do this weighted average share outstanding computation. All we're really doing is looking at number of shares outstanding at each date, how long did that last for, and we kind of do an average by months times shares, and then we add it all up and divide by 12 to get average shares. It's basically just to see the earnings per share. That way we can divide the net income, and then in this situation we're showing, hey, some of it goes to preferred, net income available for common stock, that divided by the average number of shares equals the earnings per share. So this is something to work with. First of all, kind of understanding what is net income, that we're backing out all these items. Then the weighted average shares is basically literally just the number of shares. This was always will be given to you, times how many months it lasted, all summed up, divided by 12. And then we need to back out. This is another thing that we do, is back out the preferred dividend. Why? Because there's net income that is available, and that's total, but then you have to pay your preferred, which is kind of like interest that you pay, but it's the preferred comes out at the very end, and this is the income available to common, and divided by the shares is the earnings per share, which commonly you see discussing when they talk about analysts, or earnings release comes out in this type of form.